All right, guys, Alibaba is a company that has been up and down a lot in the last couple of years. It hit an all-time high of 320 on October 27th, 2020, so a little under 3 years ago, and is now sitting at $93, and it got as low as $58 in the last year on October 24th, 2022. So guys, in a matter of 2 years, it went from 320 down to 58. That was considered unheard of back then. Like, no way that's going to happen. Alibaba's too big. Well, these things do happen. Now, on this video, we're going to go through Alibaba, some bull and bear cases, analyst estimates, stock analyzer tool to determine what price to pay for Alibaba, and also obviously looking at our 8 pillars to tell a story for Alibaba. Now, in full disclosure, I own Alibaba stock. That does not mean you should go buy the stock. You need to do your own research. I'm here to teach a process. Learn that process and apply it in a way that makes sense to you. My process is different than every other value investor I know. And I disagree with a lot of the value investors that I know, saying, I don't really like doing things that way. That is the point. But with all the value investors I know, we all think in a similar way. And that's what matters here. So teaching that process is important. Don't replicate somebody. Don't clone their investments. Go learn your process and get ideas from them, but to make your own determination. So let's go take a look at Baba here, some high-level ideas. First off, market cap, $240 billion. We're going to have a lot of information here for the early investor and the more advanced investor, all the way through. I don't care what level you're at, listen to the whole video because you'll learn something along the way no matter what. And if your goal is to become a more advanced investor, this is a great place to start. This market cap means if you bought all the shares outstanding of this company, you'd spend $239 billion. Now, enterprise value is $254 billion. That means if you bought all the shares outstanding, plus took all the debt on, and then subtracted the cash, you're going to pay $255 billion. That's the essential true cost of the business. And for a company like Alibaba, it's important to look at because it kind of tells you their debt level. $15 billion, not bad, especially for a company that has $27.8 billion in the last 12 months of free cash flow. They can pay that all off in less than 1 year. That's incredible. So, another thing to look at, their net income in the last year was $10 billion, but their free cash flow was $28 billion. That means there's probably some big write-off here that they had to take on, but I like to look at this awesome free cash flow number, and it's growing. It was the average in the last 5 years has been $20 billion. It's at $27 billion. It's currently selling for less than 10 times its free cash flow. That's an incredible, incredible number. All right. Right now, on its enterprise value that we talked about, it's at 9.13. Okay, a couple of other things. Profit margin, 5-year average, 15.7%. 1 year, 8.4. So obviously, like we said here, a big drop in net income. Now, guys, look at this gross profit, 37%. Alibaba is considered the Amazon of China. Let's go look at Amazon and see what their gross margin is and their profit margin. So remember, Alibaba's 36.7% gross margin. That means for every unit they sell, how much of that's profit. And their bottom line after paying all taxes and everything is 8.4, but their 5-year average 15.7. Let's look at Amazon. Their gross margin is 13.5, almost 65% less. Their profit margin is 0.8%, 90% less. And their 5-year profit margin is 3.8, which is 80% less. Guys, I get it. Amazon is a huge company, but I look at the numbers here going, why are these so different? Why are these so different? All right, so let's look at a couple of bull and bear cases on Alibaba. Bull cases. Ant Financial, which is their financial arm, just settled they had some infractions on them. They settled for under $1 billion. A lot of times this eliminates the whole, okay, this thing is done. Let's move on. Let's write a check. And it also appears that the Chinese probing and crackdowns on tech are subsiding with this end of this financial investigation into Alibaba. Because China for a long time was really trying to harass tech and all that stuff. And remember, guys, China is a concern about this company. However, I still do believe that China likes money. They see a very fast-growing middle class, and they want to be wealthier. It's hard to be communist and hate on companies when that is the goal. So just remember that. That's my play long-term. But again, anything can happen in the short run. That's why I look at Alibaba as a very, very long-term play. All right, a couple bear cases. One thing I don't like, their gross margin has fallen significantly. Even though it's 36.7 now, it was almost 60% at one point. That has fallen considerably, and that just shows that retail is still a big factor for Alibaba. That is why Amazon's gross margin is so low, because retail is actually not a big moneymaker for them, and it's a big factor of their business. Another one, China is restricting AI products, which is one of the driving forces for Alibaba's cloud business. That's part of the Chinese crackdown. It's still getting better, but there's still a lot of room ahead. But remember, if you can stomach the ups and downs over the next 5-10 years and you like this company, this might be one of those things that pays off, because it's hard to do very well in investing when everybody believes the same thing. That's what you got to remember. It's hard to really do well when everybody says this is important. All right. So let's go take a look at the 8 pillars for the company. Now remember, if you have our software, you can have up to 12 pillars and 4 quadrillion plus different variations of this. So sign up for our software, everythingmoney.com, $1 a day. But here are my 8 pillars, and I just like keeping these. I don't care about this 0.85% shares outstanding increase. That's nothing. China tends to be a country that doesn't buy back or issue a lot of shares. But Alibaba has a lot of buyback coming in. They're buying back a lot of their shares. So 25 billion is buying back 10% of the shares if they do it all. And they've increased it a few times. They started at 10 billion, then they increased it. And remember, guys, when you're buying back cheap shares, that's an awesome thing to do. I love that immensely when you're buying back cheap shares. All right, ROIC, not great. It's been affected a lot in the last 5 years by the net income. So that is a concern of mine, but I do think it's a temporary thing. And their net income, again, I'm not worried about this because, again, net income is down, but their free cash flow is up a ton. So I'm looking at this going, so what really, is this technically maybe even a 7 or 8 pillar stock? I don't know. But remember, you don't buy just because it's 7 pillars, 8 pillars, or whatever. These are telling a story. And the goal is to take this information and do your research later on what, if the numbers work out, what could it possibly happen for this company? So let's go look at what analysts are saying about this company. They're expecting Alibaba to make $7.60 per year, and in 5 years to make $13.30. So not quite double, but it's still pretty decent growth along the way. And there are a lot of analysts here in the first couple of years. And then obviously it dies away here as people don't want to go out further and further. As for revenue, a 10% growth a year, 124 this year, almost 200 in 5 years. All right. It's not the super growth company it was before. Look at what it did. Look at its revenue over the last 5 years, over doubled. Last 10 years, it's up, what is that, 15 times? That's a lot. 18 times, that's a lot of growth. Guys, as a company gets bigger and bigger, it's harder to grow. But as they're bigger and bigger, they're also more and more secure. And they become less sexy when they don't grow as much. And that could keep prices down for the right investor who understands that, right? So it's very, very important. All right, guys, so now let's go to the stock analyzer tool. Oh, wow, look, Alibaba's down 2% today. That's great. See, look at that difference. If you're new to our channel, I like it when a stock is down. I hope it goes back to the $58 level so I can buy more cheap shares. That's the way I want you thinking. I want you to look at it and say, great, I'm getting a sale on something that I love. Just like if you love a certain shirt, if it went on sale, you go out and buy more of it, right? No difference here. If you're a long-term investor and you realize that in the short run, stocks are a voting machine, and in the long run, they're a weighing machine, what that means is if you believe in the company and you think they're going to be bigger 10 years from now than today, and you can pay a reasonable price today, you're probably going to make a good buck. That's what's key there. That's what's very important. And you're going to avoid major, major catastrophes like Workhorse, Tattooed Chef, Nikola, and all the other stocks we warned about in the last few years that were just absolutely nosebleed. We believe that NVIDIA right now is part of that group. It's just 45 times revenue. It's going to be a tough one. Focus on companies that generate good cash flow that you can pay a reasonable price for that cash flow. So I'm going to do a 10-year analysis on Alibaba. In our software, you can do 1 to 20 years. And by the way, if you like our software and you like all the tools you've seen, guys, don't forget, we have all these other tools available. And this real estate calculator is going to be grandfathered in for anybody who signs up now. Because in a month, it goes into its own separate plan you have to pay separate for. But if you sign up now, you get this forever, including your package. And more importantly, you get this community of thousands and thousands of investors who talk every single day talking about investing. It'll keep your mentality in the right process. So guys, go to everythingmoney.com, $1 a day, $7 for 7 days. Sign up now. It's a no-brainer. You spend $10 a day on useless stuff. Spend $1 on your financial future. It makes perfect sense. So I'm going to do this analysis on Stock Analyzer tool. I'm going to put my low, middle, and high assumptions about the future of Alibaba right here. I'm going to put it right here. It's going to spit out a bunch of numbers. Stay with me through the entire rest of this video because I'm going to explain these numbers more thoroughly. We've added an extra part of the software that's even better that tells you based on today's price, if you bought it today, and these different variations happening, what return you would get if these things all play out properly. All right? So, revenue growth. I'm going to go with a low side of 4, a middle of 7, and a high side of 10. It could be much higher than 10. It could be lower than 4. Look, last year was 1.8%. But the key here is to make reasonable assumptions. I think Alibaba, being in China, the fastest growing middle class in the world, could really, really get, I think 4% a very low number for them. Now, profit margin. 10-year average is 19%, 5-year average is 16%, 1-year average is 8%. Is this decline a permanent thing? But remember, guys, their free cash flow is much higher. So I think this is temporary. I'm going to do 15, 20, and 25%. And for free cash flow, I'm going to do 20, 23, and 26%. Actually, 24 and 28%. Because if they build their cloud computing with that bigger gross margin, they could easily get these numbers right here. Now, that's the question. Can they build that up? But that's why I want my high side to be really high numbers. Because the other thing is, let's say the stock was at $1,000 and I make very high assumptions here. I want to see how overpriced the company really is. And that's what's useful about going high. Now, for PE and price to free cash flow, where should a company like this be selling? What kind of multiple? I always start at 15 and I go higher if they have a high return on invested capital and higher growth rate. And I go lower if the opposite occurs, low return on invested capital and lower growth rate. There are a lot of risks involved with China as well, but I'm going to factor that into my desired return. So I'm going to sit here and just go with 14, 17, and 20. PE and price of free cash flow. That's what I'm going to do. I'm going to stick right there. Can I see the argument of 13, 16? Actually, you know what? I'm going to do 13, 16, and 19. And by the way, guys, I want you to see this thing changes every time I do it. But the point is, I shouldn't come up with $300 per share as a value one time and $20 another time. Maybe it's 80 this time and 90 next time. The bottom line is you should only be buying a stock when it's pretty clear it's a good buy. That's my kind of thesis here. So it's going to change all the time every time I do this software. It's changed in the last 2 years. But the point is, overall, I can look at it and say, this seems overpriced or this seems like a good value. All right. Now, finally, my desired annual return. This is my margin of safety. As I make higher assumptions, I need a higher return. And as I do the higher return, that's a higher margin of safety. 9 or 10% is what you're going to get in the market over long periods of time. With China here and other things, I do want a higher return than this. I'm going to put 12.5%, 15%, and 17.5%. Now, I'm going to hit the Analyze button. Again, guys, we're going to see several numbers here. Please stay with me to the end of this video so you can understand these numbers very well. Scroll down, boom. A low price of 84 to 112, a high price of 190 to 212, and a middle price of 130 to 150. Now remember, guys, these are very high desired returns. Our final row here, if you paid the current price and our low assumptions occur, you're going to make about 15.7%. If you paid today's price and the middle assumptions occur, you're going to make about 24%. And if you paid the current price and the high numbers occur, you're going to make about 30% over the next 10 years. This isn't a guarantee. This is assuming your assumptions occur. But the point is, if you had 10 or 15 companies like this and you bought them all like this, you'd probably do pretty well. So guys, again, everythingmoney.com. Check it out. $1 per day for 7 days. This part alone is worth probably $5 a day. Thank you very much for your time.